Stocks see a sharp drop before seeing a small recovery after US equities and weak on Friday following strong payroll data, surging oil prices and a weak rupee also dent sentiment. Realty and consumer durables are the biggest losers today.
Oil flares up with Brent topping $81 a barrel after US imposes sanctions on Russian oil producers, oil shipping companies and insurers. Stocks of oil producers gain while those of the oil users take a beating.
Rupee sees its biggest fall in over 2 years, sliding nearly 0.5% against the dollar after the dollar index surges to closer to 110. Higher crude prices also weigh on the sentiment. Call rate and bond yields spike as bankers say repo rate cut in the late February looks off the table. Instead, see another CRR cut.
Avenue Supermarts, the owner of retail brand Dmart, is set to see CEO Neville Noronha step down in January next year after 2 decades at the helm. Anshul Asawa's Unilever's head of Thailand will step into his shoes.
Biocon Biologics insulin unit gets cleared by the US FDA with a voluntary action indicated. This paves the way for key drug launches from the unit driving up the stock.
Good afternoon. You're with us here on Halftime Report on CNBC-TV18. I'm Hormuz Patakia. With me is Mangalam Malu as always. Mangalam, good afternoon. Well, it could have been bad as what the global markets are suggesting. It's still not good by any means. It's still down 200 points on the index. There was a bit of a recovery from the opening lows, but then that has very swiftly gotten sold into. The Sensex is back down around 600 points as we speak, but the pain though is in the broader markets. It was bad last week and it has not seen any improvement this time around as well. At the start of the week, 2.5% lower on the mid cap index, and same goes for the small cap index as well. Remember, the small cap index was down 7% last week, with almost a third of the index seeing losses of well over 10% all through the week gone by. And there are a lot of result reactions as well. Both Just Dial and PCBL are down 7% each. That Kalyan Jewellers too continues to see a drop from where we left off last week, but there is absolutely no respite from any stock scene in the broader markets as well.
No respite for any stocks. You know, you remember that old show that was there on one of those OTTs, and the iconic dialogue by the character out there can very well apply to the bulls here. Rose Utho, Nahao, Pito or Sojao. That's exactly what the sentiment of the market is right now. From January 2nd highs on the Nifty, we're actually now down almost 1,000 points. The Nifty's high that day was 24,226 thereabouts. Where are we right now? 23,219. The recovery that we saw in the morning itself has swiftly been sold into. We're back around the lower end of the trading range today. And if you just look at the nature of the stocks, and now it's beginning to look a lot scarier. Why do I say that? Look at something like a Trent, which has been a big outperformer. It's now down 25% from the highs, and the ferocity with which we're seeing selling out here is down about 5%. Kalyan Jewellers, we were talking about how the update was fairly strong. The management joined us, said that there was nothing really that the street should worry about, etc. It was largely, valuation related, etc. Look at that stock, down 7%. PB Fintech, again, down almost 7%. You have APL Apollo, Macrotech developers, we're talking about the real estate cycle, etc. That stock itself is down 7%. So the kind of pain that we're seeing in the broader markets is, not only from the number of stocks which are declining, but the manner in which they're declining is also hurting. So not just the breadth, but also the depth. And in light of that extremely red screen, we have one of few stocks which are actually gaining. One of them at the bottom of your screen, BSE up around 1.5%. And the other one is Biocon, trading in the green after its Malaysia unit has been cleared by the US regulators with just a voluntary action indicated. Vinny joins in with more details on Biocon as well. BSE up around 1.8%, Biocon too up around 1.7%.
Hi, Mangalam. Good morning. So yes, we are seeing Biocon that's buzzing in trade today because of this Malaysia facility. It's an important one that's come in for Biocon Biologics, and everyone was waiting out for this one. So this positive news coming in here is keeping the stock abuzz. Now, obviously, this facility actually was inspected in September 2024, where they received 5 observations, and now voluntary action indicated as a positive sign. It paves the pathway for the company in terms of new launches that are expected coming in. Especially, this would be for the US market. So that will give a boost coming in for the biologic side of the business. Regulatory hurdles, they are past and they're behind them, because Bangalore was one of the recent ones in terms of biologics business where that got an approval, and now Malaysia. So 2 approvals back to back, positive news there as well. 2 launches that are planned by the company as well. Ustekinumab, which is expected to be launched in Feb 2025, and there is one more drug also that will be launched soon. So yes, new launches. Good pipeline coming in. Analysts are giving it a thumbs up. Motilal has upgraded the target price as well. So yes, important one to watch out for.
Indeed, Vinny, thanks a lot for that. Although Biocon now off the highs of the day, but still holding on to some gains of around 1.5%. Just before we go to Upasana, you remember Mangalam just talking about the way the stocks have fallen. 27th of September last year was when the Nifty had made its record high, right? Almost 4 stocks on the Nifty are now down over 30% since that day, and almost 12 stocks are down between 20 to 30%. So at least 16 stocks, at least a third of the index, has now corrected anywhere between 20 to 35% since the 27th of September. And one such name in the broader markets, though, reacting to results today is PCBL, and Upasana is here to tell us why the stock is under pressure after its results. Upasana.
Well, overall, if we look at the results, they were much softer than what the street was anticipating. This is mainly due to lower volume seen in company's key segment, that is carbon black, particularly in specialty carbon black, and also Aquafarm also reported a tepid performance. Now, looking at the numbers, the revenue stood at 2,010 crore with an uptick of 21% on a YoY basis, and EBITDA margin saw a downtick of nearly about 90 basis points. This is mainly on account of the change in the sales mix of the company. Hence, margins stood at 15.9% versus 16.8%. Now, coming to the profits of the company, they are seeing a degrowth of nearly about 37%. This is mainly due to a 5-fold rise in company's finance cost, and even the depreciation has doubled up, denting the overall PAT performance. Now, company has said that it is expecting significant growth in international sales volume, mainly in European markets, and the demand for specialty products also continues to remain resilient, is what the company has highlighted in its management commentary. So all in all, margins, change in product mix, and overall the profitability hurt is what is reeling the stock downwards.
Multiple factors responsible for the fall in PCBL. Upasana, thanks a lot for that. You remember one of the times sometime during last year when Sanjeev Goenka spoke to us, the stock had seen a massive run-up as well, and now almost 23% now over the last 1 month. So one of the earnings reactions today, PCBL. Time for Growth Code now before we slip into a short break. That is an initiative by Grow and CNBC-TV18 that is designed to provide you with valuable trading strategies. This week, CNBC-TV18's Nigel D'Souza sat down with Praful Kulkarni, who is the founder of Alpha Leo Capital, to understand why is the ability to adapt to market conditions critical for long-term trading success.
Why is the ability to adapt to market conditions critical for long-term trading success?
Market works in cycles, market works in regimes. Certain regimes work for certain trading styles, and certain regimes are not so conducive for one particular trading style. So once you identify the regime, that kind of determines your stance for that particular regime. That is, every trader has a period of going very aggressive with his approach versus he'll be forced to being defensive in his approach. So when the regime is conducive to your particular trading style, the trader has to push on the gas and he has to go aggressive. And once he determines that, oh, this regime is not completely conducive for my trading style, he has to focus more on not giving up the money that he has made in the regimes which were conducive to his style. So this kind of determines the profitability and ensures the sustainability in the long term. Because market gives opportunity to every kind of trader at least few months in a year.
Welcome back, and the Nifty continues to remain 200 points lower. The broader markets down over 2% each. We spoke of one earnings reaction before the break, that was PCBL. The other one is Just Dial, and that too is not seeing any respite from the selling pressure that it has seen all through the trading session. 8% lower currently for Just Dial, and Rima is here to break down the numbers for us. Rima.
Thanks so much for that. So reason number one is revenue growth has slowed for the company. It stands at 0.9% on a quarter-on-quarter basis and on a year-on-year basis at 8.4%. If you compare these growth rates with the recent trajectory, you would see that growth has slowed down. So for instance, the top line growth at 0.9% in Q3 would compare with a 1.9% growth in Q2 or 3.8% growth in the prior quarter. And even on a year-on-year basis, it's still a high single-digit kind of a growth run rate. Secondly, collections for the company have weakened. The company's aspiration was to have collections of 10 to 15%. Versus that, in 9 months, the company's done collections of 5.6%. So clearly, there are monetization challenges. Margins for the company have inched up, which is a positive. They stand at 30.1%, and that's on account of reduced headwinds. But to this, Ambit says the lack of investment in sales force and marketing has started to impact collections growth, and therefore persistent sub 10% billing growth at a time when the company is only focusing on maximizing margins is one of the key sell catalysts for the company. So they don't like the fact that the billing growth is sub 10%. So between Just Dial and India Mart, both with a similar business model, they prefer India Mart. On Just Dial, Ambit has a sell call with a target price of 1,037.
All right, we take that point. Rima, thanks a lot for that. With that, we'll take a short break. On the other side, we'll get talking technicals. Manish Athiramani of Deen Dayal Investments joins in with some trading strategies on the other side. Stay with us.
And your son's sailing, I believe. Yeah. So, talk about all the lessons and all of that. Are we on the cusp of a breakout moment for the experience economy in India?
It's like the analogy from Formula One. So the car that's in front of you is cutting through and creating the slipstream and using more power and energy.
Yeah.
And the guy who's behind you is using 25% less. And he can press the DRS and get ahead of you.
Yes.
We live in 4 Indias. We live in the London of India, which is about 5 million people. And then there's about 50 to 60 million Indians, which I call the United Kingdom of India. Then there's 400 million Indians, which I call the Brazil of India. And then you've got about 300 to 350 million Indians, which I call the Africa of India.
Let's address the issue that you've been dealing with in the last few months on account of what's happened with Coldplay. You've got investigative agencies, you've got the EOW, you've got the GST authorities.
I've got a clean conscience. My karma is good. I sleep well.
Welcome back. The Nifty down nearly 200 points right now, hovering around the lower end of today's trading range so far. Perfect time to get you an update on how the market's poised at midday itself from the F&O standpoint. 23,200 just on the verge of breaking once again. This brings us to the fact that, the Nifty has had actually lower highs for the 8th straight session. Jan 2, the high was 24,226. Right now, we're 1,000 points lower. But progressively, if you look at it, the Nifty has been making lower levels. Jan 8, 9, 10 and 13 as well. Today's high on the Nifty is 23,341. What's interesting is that earlier the lows were being maintained. Earlier, we were seeing support around the 24,500 to 24,460. And if you look at the recent lows on the Nifty, December 31st was 23,460. Thereafter, Jan 8, Jan 9, 23,500 thereabouts. But it was on Jan 10th where the Nifty broke past that December 31st low, and thereafter the ferocity of selling increased, and today's low on the Nifty 23,172. What's interesting is that today's high on the Nifty is 23,341, which is still lower than the previous low that we had on the Nifty, which was 23,344 itself. The pain in the broader markets is a lot more. 7 to 8% decline this month in the mid-cap and the small-cap index itself. And you can witness that in the kind of decline that we've seen today as well. 2,200 stocks in the red for just about 300 stocks in the green itself. For the very near term, what are the option writers penciling in? 23,200 put writers are fairly active. Let's see where this goes, because they have a premium of almost 130 rupees at stake. So can the Nifty see some support at 2350, 2370 thereabouts or not is the big question. On the way up, however, call writers have come back once again saying that at higher levels around 23,400 thereabout itself, there would be a lot of congestion. But these are only options that expire this Thursday. There is weakness that is expected entire series, and that is why the 23,000 put writers of the options that expire on Jan 30th itself have now begun to unwind their position. So they're running for cover. We'll keep an eye out on that one. The one stock that I'm watching out for is Aarti Industries. It may enter F&O ban today. So those are a bunch of stocks which we are watching out for. But progressively, the market is making lower lows and rather lower highs and lower lows. And today's high has actually been lower than the previous low as well.
Well, not good going for the markets whatsoever. Now lower levels coming into play because both the Nifty and the Nifty Bank are now significantly away from their 200-day moving average. So what next on the charts for the indices and for specific stocks as well? Manish Hathiramani of Deendayal Investments is joining us to answer that question. Manish, good afternoon. Thank you so much for joining in. You know, last week we were talking of 23,500 being defended on the index. How crucial is that level? Now we flip the question to how is there a possibility for the Nifty to test the lows that it made on the 4th of June last year? What are the charts indicating there? And couple that up with your stock recommendations as well.
Good afternoon, Hormuz, Mangalam, and to all our viewers. Thank you so much for having me on the show. Well, to do a little bit of a recap, what we had discussed last week was a range which was between 23,400 and 24,200. Now, what's happened is that we have broken 23,400, which means that the lower end of the range has been disrespected. We are no longer range bound, we are bearish, and we will try to look for any opportunity to go short. However, there should be a small little disclaimer here that we should be able to close below this level today. If today's lows are going to be closing below the levels of 23,300, only then would I initiate fresh short positions, and that would be for a target of 22,500. If we are unable to close, I would like to watch out for a couple of days. The next level of resistance on the upside would probably be around 23,600.
And what about stocks as well, Manish?
So I'm again working with 2 sell calls, but I also have a buy call this week. My sell call is on ICICI Bank for a target of 1209, stop loss of 1255. The stock has been on a weak spree till we broke the supports of 1260. We expect a further drop, which should take it to the next support level, which is about 1200 to 1210. The next one is a sell on Kotak Bank, which is for a target of 1715. Stop loss of 1787. We have broken 2 important levels of the 20th and the 30th of December, along with an important support of 1760. I have a solitary buy call on PCS, which is for a target of 4450 and a stop loss of 4040. The stock has broken out of the resistance of 4250 and is maintaining above that. We should allow it to move further and achieve levels closer to 4450.
Take that point. Thank you for joining in. 4450 is what your view on TCS is, but I remember HDFC Bank down 8% in this month itself was your call. You got that spot on. Thank you, Manish, for joining in and giving us your calls. But, you know, moving away from the equity market, and perhaps one of the bigger reasons for the decline in the equity market today could also be on what's taking place in the currency market, the rupee market. There is a fair amount of drama that is taking place right now. 86.4650, closing in on 86.5 out here. Bond yields have spiked as well following a rise in US yields. Who else do we go to for all things macro? Lata joined us in the studio. Lata, rupees only falling more.
Well, if the rupee buys less, obviously everything falls, and that's what we are witnessing at this point in time, a fall to 86.46. And that means a 0.5% fall. This is the sharpest, record keepers tell us, since February of 2023. But who knows, that record could be taken. Many Asian currencies, baht, Filipino peso, ringgit also falling, but yuan, onshore and offshore, haven't fallen. Clearly, if everything is falling, it's because the dollar has risen. The dollar index is up by almost 0.5%, 0.43. So this is an arithmetic fall that you're seeing in all the currencies. The key reason, of course, is that the US jobs data has come in very strong, much stronger, 256,000 compared to the expectation that only 155,000 jobs will be created in December. And that means if the economy is strong, there is no need for a rate cut. And also, if wages are higher, the inflation numbers may also be higher than expected. Again, no reason for a rate cut. And that's the reason why yields have also spiked. Now, just finishing the rupee argument, dealers say largely the buying of dollars is by equity guys, FPIs, and usually there is a sale by RBI. Today, people have not reported too much of RBI supply of dollars. Usually, RBI doesn't stand in the way when it's a global trend. The yield market, as I told you, the US yields have risen, and that is getting reflected in India. The bond yields, 10-year bond yields are up by about 3 basis points to 6.83 from 6.8, but that's not the story. The story is the one-day money. Call rate has jumped to 7%. Now, the call rate should be what the repo rate is. Why does the MPC declare a repo rate? It tells the RBI you have to keep one-day money at 6.5%. That is at 7. Why would it be, people, it's quite possible that there is an argument that the Reserve Bank is keeping the liquidity tight so that people will stay in rupees. It gives you a higher yield for one day, 7%, rather than jump to the dollar. There is that theory doing the rounds, but the Reserve Bank has announced a variable rate repo to give 50,000 crores to the market. But the deficit in the market is almost 2 lakh crores. So this is not going to suffice. And we are going to see yields very high. US 10-year yields have jumped to 4.76, about 7 basis point jump on Friday itself. And therefore, you will see commensurate moves in the Indian market. The important point is now the rate cut that was expected in the February policy, what with the new governor and all those hopes, that is completely wiped clean. Now, the expectation, which is why the yields are jumping, the expectation now is that probably a CRR cut is needed, another 50 basis. No one's talking of a rate cut at this point in time. That's the new reality that the bond market's faced with.
Both in India and in the US as well, right? Lata, thanks a lot for that explainer on the rupee nearing towards 86.50 now this afternoon. Time for a short break, more on the markets and specific stocks on the other side. Stay tuned. Welcome back, and you're trying to find out some laggards in the broader markets. You'll find plenty of them. One of them is RVNL, Rail Vikas Nigam. That's down almost 7.5% as we speak and down to the lowest point of the day. But the reason to highlight RVNL is the fact that it's down almost 45% now from its peak of 647, which it had made last year. And even then, the stock is still expensive when it compared to its 5-year multiple. At FY26 multiple still at 42 times. The 5-year average is 12 times. So it shows the kind of moves that RVNL has seen. But there are some other movers as well. One of the positive movers, at least as of now, was BSE. They're still holding on to gains at the start of the show, and that was because Goldman Sachs had initiated coverage on the stock with a buy recommendation, with a neutral rating actually. They'd come out with a neutral rating and a price target of 5,060, and that price target is already below where the current share price of BSE is, which is well above 5,200. Now, what Goldman Sachs is saying is that it stands to benefit from the strong growth tailwinds that India's capital market has, the nominal growth in corporate earnings that will be a big driver for its trading income, which is a big part of BSE's revenue. But despite all the positives, why are they neutral? Well, they are neutral because of the fact that valuations of BSE are near an all-time high, considering the run-up that the stock has seen. And as a result of which, they see risk-reward is largely balanced, so price to perfection is what you can call that, and hence Goldman Sachs is neutral on BSE. The other one though was Hyundai, and the new listing, India's largest IPO, continues to get positive coverage from analysts. Another one coming in from HSBC, 2,200 rupee price target buy rating. They say that they are well positioned to benefit from the long-term growth in India's auto sales. They have a strong global parent, they have an equally strong local brand positioning as well, and their new launches and capacity expansion will drive growth over the next 2 to 3 years for Hyundai. And what they're saying is that although a weaker than expected launches of new models is a key downside risk for Hyundai. So no major reaction here, but CLSA 2 has initiated coverage and an outperform rating there, 2155 price target, and it says that it is one of the few foreign car makers who have survived the competition in the domestic markets for well over 2 decades now, and capacity from the Talegaon plant, which is set to come on stream soon, that will be a key growth trigger from FY27. So positive commentary continuing for Hyundai. 14 out of the 17 analysts have a buy rating on the stock, but still it continues to trade below its IPO price. But the stock of the morning, though, was Avenue Supermarts, and that is the owner of the retail brand Dmart, and that is set to see CEO Neville Noronha step down in January next year after 2 decades at the helm. Now, Anshul Asawa, who is Unilever's head of Thailand, will step into his shoes. Manglam has hopped over to the wall to tell us more about this leadership change.
Well, it's the end of an era at Avenue Supermarts, as along with the third quarter results came a management change note, which said that Neville Noronha will step down as the MD and CEO on Jan 31st, 2026 by not renewing his current contract. He steps down after over 2 decades at Dmart. At Dmart, Neville, the unassuming rock star CEO, led Dmart to be among the largest supermarket chains in the country. He joined in 2004 when the chain had just 5 stores and scaled it to over 380 plus stores with an annual turnover or over 50,000 crores as well. Not just that, he also led the company to a successful IPO, and we all remember from a 299 rupee issue price, Dmart has returned over 12 times to the shareholders, the recent underperformance notwithstanding, and the biggest beneficiary of that, among the biggest beneficiaries of the Dmart listing has been Neville himself, owning about 2% of stake in the company worth nearly 4,700 crores, making him the richest professional CEO in the country. Known to be usually media shy, Neville Noronha did open up to CNBC-TV18 on 2 occasions in the last 6 years and gave us some quotable quotes. My favorites are, on retail, where he said, retail is detail, retail is speed, and retail is a particular entrepreneur's original thinking. You mix all of them together and you get a moat. Clones will find it very hard to catch up. But also, he was among the first to call out the challenge of quick commerce when in May 2024 itself, here on CNBC-TV18 Digital, he said that digital e-commerce is the next big challenge for us all, both platforms and quick commerce, and as a result of which, entry barriers will reduce for most, if not all, retail businesses. That could reduce profit pools for retail, and as a result of which, we also saw margins for Dmart decline. On his leadership, he's fairly humble. He said, we're all outcomes of the timing and alignment of our skills versus what is needed at that specific time itself. No big deal. But as the tide turns and we look at another chapter in the life of Dmart, let's also tell you a little about Anshul Asawa, who joins the company on March 15, 2025 as CEO designate, will succeed Neville Noronha from Feb 1, 2026 itself. Anshul is an IIT Roorkee and IIM Lucknow alumnus who currently serves as the country head Thailand, Unilever that is. He's been with Unilever for over 30 years, where he's led digitization efforts at Hindustan Unilever, has been at the forefront of leading innovations, and at Unilever, he was known for consumer centricity, commercial discipline, and execution focus. These tenets, along with the underlying change in retail environment, make him best suited to lead Dmart itself. How retail or Dmart evolves is one thing, but the other thing that we'll watch out for in the future is the importance of Unilever as the CEO factory. I mean, we keep talking about, leaders from Unilever going on and leading other companies, some illustrious recent ones that we have. Sudhir Sitapati at the helm of Brokerage Consumer. You have Prabha Narasimhan, ex-Unilever at Colgate-Palmolive. Geetika Mehta, again, ex-Unilever, first went to Hershey's and thereafter Nivea India. And then you have some of the others as well that come up for you. Sudhanshu Vats, currently the MD designate of Pidilite. Prateek Pota from Unilever and Pepsi went to Jubilant Foodworks. Eureka Forbes. Thereafter, Neville Noronha himself is a Unilever alumnus. And if you look at the old guard as well, Varun Berry, ex-Unilever, Suresh Narayanan of Nestle, ex-Unilever, Sunil D'Souza of Tata Consumer, ex-Unilever, among many others as well. So leadership change at Dmart and leadership factory of Unilever intact.
Well, indeed, Manglam, thanks a lot for that. It's indeed a leadership generating factory is Unilever. But we'll take this conversation forward with Abneesh Roy, who is the Executive Director at Nuvama Institutional Equities, who is joining in on the show now. Abneesh, good afternoon. Thank you so much for joining in. Would you call this a sudden, unexpected announcement on the leadership change for Dmart? And what would you, or how do you classify the numbers as well? Because margins saw a contraction, although the top line growth was fairly robust.
Yeah, thanks. Yes, it was a slight surprise. But when you see 22 years and 2% kind of a stake, obviously Dmart is quite well run. So big shoes to fill. But I don't think in such large companies, one person exiting will make a big difference because there is a very good template. I think challenges for the new MD will, of course, be in terms of e-commerce and how to ramp up the margins in terms of the competition. And of course, in terms of the discretionary part of the portfolio, I think still a lot of steps are needed. Of course, what is going right in terms of expansion, compounding machine, and in terms of sales also, if you see this time, the delivery was quite good. So I would say that slightly unexpected, but I don't think this is a big concern from a medium long term, because clearly the pedigree of the new person is very similar to what Neville had. And Neville will be having a lot of time to really groom him. Of course, promoter and the rest of the team is also quite well placed. So from a margins perspective, this quarter, I think the negative surprise was largely expected given very high competition from Swiggy, Zomato, Zepto, etc. Dmart has done well in terms of sales, but in terms of margins, clearly the industry is seeing very high promotional intensity. And that, I think, as a concern will continue to remain. And that's why we have also cut our numbers. We have a neutral rating, a good compounding machine, but near-term margin, I think compression will remain in terms of risk.
All right, good compounding machine. Near-term margins will be under pressure. Abneesh, thank you for joining in. Now let's talk about the 1 year from here on. You've released your report of 2025, where you see key demand drivers as rural, and in the second half of the calendar year, you will see some recovery in urban demand as well. Diversification, AI, and quality of rural distribution, all of them are key themes. What interests me now is that among your top buys for 2025, we have United Spirits, Marico, Pidilite, and United Breweries. No problems with United Spirits, Marico, or Pidilite, but your outlook on UBL in the very near term, given the Andhra issue, could there be some more disruption or price disruption before we see some improvement? Because no problems on the long-term potential of this industry and the turnaround under the new CEO, but the very near term seems a little uncertain, right?
No, in fact, this is a question on Telangana. So yes, this is a very bold but positive move, because if you see both in terms of collection in Telangana and price hike, last 4 years, there is no hike. So from here on, I think it will be improvement. Yes, near term, some numbers will be impacted, but in this kind of a liquor business, investors are looking at profitability also. And with a 70-75% market share in Telangana, I clearly see that the pricing growth should come back once government realizes that customer is not getting the brand, because in this kind of a business, to create capacity takes a lot of time, and rest of the players also make losses in Telangana. So it is not that they will start making profit. Second is leakage from other states will happen. So Kingfisher will be available from other states. So I would say that with 4,000 crore kind of tax being given to the government by United Breweries, I think this is a good step. This is a bold move, but this will lead to definitely positive outcome. Of course, timelines difficult to predict, but my sense is state government is losing tax from day one. And clearly, as I said, leakage will happen from other states. So it's a loss-making state for United Breweries. It contributes 15 to 17% of volumes. But from a negative EBITDA, eventually it will turn positive EBITDA. And this quarter also, if you see Q3, we expect 8% plus volume growth for UBPL. Of course, Q4, there will be some impact of Telangana. But eventually, EBITDA-wise, it will not be much of an impact.
Abneesh, you're mentioning there is some recovery that you're expecting on a gradual basis, at least in 2025. But what are some of the key risks to this theory of you seeing some gradual recovery? Are there any on the anvil?
So firstly, on the stocks, if you see CY24, it was a challenging year for consumer sector. It was generally the staples were out of the theme and out of flavor. We see that improving because growth in India is challenging for most sectors. But in FMCG, if you see pricing growth is coming back, rural is doing well. From a risk perspective, there are two risks. So if you see in urban India, currently growth is challenging. You will see in Q3, Brokerage consumer, Tata consumer, Nestle posting fairly disappointing numbers. I think Street is aware of that. But that is the risk that with inflation again coming back, for example, if crude is at $81, rupee is also depreciating, that again will lead to more inflation. And how does that impact the lower end of urban consumer? That is, I think, one risk. The other could be, again, raw material risk also, because again, this is also linked. So in terms of margins, how do we see? My sense is in the December quarter and Jan quarter, there should be some margin pressure for most of the staples companies. But I would say that pricing growth will come back and local and D2C players will lose out. So that's where I think the market share gains will happen. And the pricing growth will lead to operating leverage. So more of a gradual recovery. But I think in the current weakness in staples, I think Colgate, Britannia, Lever are looking good. But once the Q4 results are done, I think Brokerage Consumer, Tata Consumer will also see interest coming back, and even Nestle. But in those three stocks, in the near term, there is going to be a lack of triggers.
All right, just a final question before we let you go. Typically, we ask you about the entire year, etc. But the next 13-14-day period is the Kumbh Mela. Typically, a boost for consumption in that period. Have you heard from consumer companies on the plans that they have for the Kumbh and any sort of demand generators out there?
Yeah, very good question. I think this will lead to a lot of 40 crore kind of footfalls and clearly a lot of revenue opportunities, a lot of marketing opportunities. I think Dabur, Britannia, Varun Beverages, Pepsi, etc., and of course Unilever, all the FMCG companies are tapping that, and this should give a slight fillip. I don't think it moves the needle too much because it's a 45-day period, and there will be a lot of marketing opportunity rather than revenue opportunity in my view. But of course, this helps further rural consumption because this is a tier 3 kind of a consumption. So we are positive on it, and we do see the large companies really invest in that and get some revenue opportunities.
All right, Abneesh, thank you so much for joining in and sparing time and sharing with us your views on Dmart and on the entire consumption space as well. By the way, still 23,200. The bulls fighting to defend that level, tooth and nail for the Nifty. Be interesting to see if the second half manages to bring about any form of respite for the index. Where there is no respite, though, are the broader markets still continuing to remain at the lowest point of the day. Time for a short break, then more on the markets and specific stocks on the other side. Stay tuned. Welcome back. Just before we went into the break, we spoke to you about the mid-cap index still being at the lowest point of the day, still down over 2.5% after a near 6% fall in the week gone by. So the pain continuing in the broader markets. Some of the top losers then in the broader markets, we spoke of PCBL, we spoke of Just Dial, but Blue Star too is adding on to the losses that it saw in the week gone by. 8% lower now for Blue Star. That too is down now to the lowest point of the day. The selling pressure continues in Kalyan Jewelers, down another 7% today. And what's also down another 7% today is Macrotech. Shared its business updates last week, which was fairly on the good side, but still there has been no recovery so far in shares of Macrotech. That too are down 7%. But what is bucking the trend though in an otherwise weak market is Piramal Pharma. That continues to trade with gains of around 6% off the highs of the day, because at one point was up almost 8.5%, but still holding on to gains of 6% in a market where the broader market index is down well over 1,000 points. So these are some of the movers in the broader markets as of now. We'll take a break again. On the other side, Manisha Gupta will join in with Narendra Taneja, who is an energy expert. Stay tuned. We'll be back on the other side.
Welcome back, and crude is in focus as we've seen the prices trade at a multi-month highs. Joining us for a discussion on the same is Narendra Taneja. He's an energy expert. Mr. Taneja, hi, thank you so much for joining us. I remember when we were talking at the end of last year, it was, there were three uncertainties that we got into the year with. One was Chinese demand, second was whether or not the war situation will escalate, and third was clearly about tariffs and sanctions clearly seems to have come in first. With these sanctions that the U.S. Treasury Department has put on Russia, we've seen prices gain up on a premium. But how are you reading the impact of these?
Well, two things here. First of all, if you see it very with a microscope, it is everything to do with the domestic politics of the U.S. President Biden, he's got limited a few days left now. He's trying to make life as difficult as possible for President Trump, especially when it comes to foreign policy in general and Russia and Ukraine policy in particular. So you see, so the whole idea is to make it kind of, President Biden wants to leave his legacy when it comes to Ukraine and his policy on Russia and overall on NATO. So it has more to do with that. Now, the question is that American president, Mr. President Biden is a very powerful position. He can do whatever he wants to. But within the next few days, come the 20th, and President Trump will be in power. So he may not really say, all right, goodbye to the sanction, but chances are he's going to ignore it, because if oil prices go beyond $80 per barrel on sustained basis, that will be a very, very bad beginning for President Trump, which he can't afford. If oil prices are high, American voters, American consumers are very, very unhappy. That's not going to basically, fall within the kind of agenda that President Trump has got. His agenda is to make America great again, and you can't make America great again with $85 per barrel, for oil. So evidently he's going to do something. But Biden wants basically working on his legacy, making life difficult for his successor as far as deep as possible. And so this is part of that. The question is, would that stay? I'm not unduly worried. I think, once President Trump moves into the White House, within 15 days, you will see the effect, and market will reflect accordingly, and prices will start going down.
Mr. Taneja, the second part of the story really is that much of this Russian oil perhaps comes to Asia rather than Europe. So China and India, do you see an impact on those shipments?
Oh, evidently, of course. The thing is that China and India today, in fact, India is the more important buyer of Russian oil than China. And Asia is booming. The entire region is booming. And they need Russian oil, and especially when, cheap Russian oil. So my own sense is we don't need to worry too much about it. It's for bad news for Indian rupee, for fiscal deficit, for our balance, for everything practically, especially when it comes to India, and the bad news for China too. But that said, at the same time, I think, there is a little window of hope. The window of hope is that Russia, in the meantime, they try to bring the oil prices further. As you know, there is a G7 cap of $60 per barrel. So which means in the meantime, Russia will have to find a way to sell oil maybe less than $60 per barrel, so that, charters can go for more ships, or Russians can go for more ships and ship it to India and China, so that it continues to be business as usual until and unless, President Trump brings in a little bit of more order, or the kind of his own stamp on the whole story. So I think I'm not unduly worried, but in the short term, it's a bad news for us, it's bad news for China, it's bad news for practically all importers. And that means roughly 80% of the world country, because 80% countries are energy deficit on the planet. So it's bad news for global economy, but I hope that President Trump will act on it as soon as possible.
Oh, well, absolutely. I mean, as you said, prices can go higher in the near term, but come Trump and we will see some stability come in here. For India specifically as well, I mean, as you mentioned, we're looking at crude oil prices at multi-month highs. We are looking at rupee at record lows at 86.5. So if you look at oil imports at these levels, are we looking at worrying numbers then?
Yes, in short-term worrying numbers, maybe for about 4 weeks to 6 weeks, until the new government settles in the U.S. and they start initiating, on Russia and Ukraine and so on and so forth. So I think in the short term, yes. And also, let's not forget one thing, our dependence on oil is only growing. Our consumption is going up by, 3 to 4%. And India today is actually one of the key importers of crude oil in the world, especially when it comes to Russian oil. So my own sense is that, overall optimism there, as a private sector refiner has recently entered into a major contract with Rosneft, Russia's state-owned, big exporter of crude oil. That's roughly about $12 to $13 billion a year, and it's a long-term contract. I gather a couple of other Indian refiners are getting into similar contracts with Russian exporters. So I think while they work on all these numbers, and the China is doing more or less the same, I think the countries or the government have to handle these things. And I'm sure when our foreign minister visits Washington, D.C. for the inaugural of President Trump, this is going to be right on the top of the agenda. And not only India, China, other smaller countries too are going to be more or less there. I'm not unduly worried. But what I'm worried about is that, instead of actually leaving a positive legacy, a positive agenda, President Biden is actually making life a little more difficult. He thinks he's making life difficult for his successor. But in the process, he's also making life difficult for major economies, especially in our part of the world, including India and China.
Oh, well, absolutely. What is your sense then on the prices going forward from here? I mean, I understand there's just too many uncertainties going on from here. But even if you take yay or nay or do case studies with all of that, what is the range that you think the crude prices will see for this year?
Well, good question. You see, if you go by demand and supply fundamentals, oil should not be more than $70 per barrel. And demand supply fundamentals are the most powerful force when it comes to the commodities market globally. But at the same time, this territory that, which basically has resulted into prices going up, that's a familiar territory for the oil sector, for oil traders, for oil exporters, for oil importers, for India and China, and for the United States. So it's a familiar. We know what's going on. At the same time, we know what to do in order to bring the prices down or bring the sentiments actually to the kind of more acceptable level. So it's not uncharted territory. It's a familiar territory. That's what I'm not unduly worried. And I'm sure New Delhi also, the finance minister, may not also be unduly worried. I'm sure he's picking up phone, talking with our foreign minister. And India and China and Japan, South Korea, they must have already started, talking with each other what to do in such a situation, because they are all large importers of crude oil. I'm not unduly worried, but as I said, in the short term, I see prices may go up even $85 per barrel. Don't be surprised, $87 per barrel, or even may touch 90. But I think, because the factor will be mainly geopolitical, mainly President Biden. So I think we don't need to understand really, because President Trump, we all know that he has a different agenda when it comes to Ukraine and Russia, even when it comes to crude oil prices, because he's the man who's talking of drill, baby, drill, which effectively means lower oil prices. So I'm not unduly worried, but next 3-4 weeks are going to be tough.
Got it, Mr. Taneja. Thank you so much for joining in and giving us your views. In the near term, there may be a bit of a spike, but nothing to worry about in the mid to long term. Thank you, Manisha, for taking us through with that conversation. We're staring at 200-point losses on the Nifty. What we'll do is slip into a short break, come back on the other side. The team of Business Lunch will take all the market action forward.